QuickBooks has their own in-house funding through QuickBooks Capital. And actually, this is one of the game-changing products out there. I've been able to get hundreds of thousands through QuickBooks Capital, term loans, lines of credit. And the great thing is you don't have to provide any paperwork because everything's already tracked, right? You're going to link your credit card accounts, your bank accounts. It has read access to that. So when you are categorizing your transactions in QuickBooks, all of that data will roll up to a balance sheet, a profit and loss statement. And so they'll take that at face value, and your data is already validated because it's electronic, right? You can't manipulate your bank balances, right? So that's another great thing about QuickBooks. It's like you don't have to go through this vetting process because they're refreshing your account balances probably every 24 hours. All right. So right down here, we got our CD accounts, we got our money market, we got our expense account, and our main operating account. Now, you might be thinking right here, all right, why would you have two different accounts? And I'll tell you why. So there's a lot of different fintechs, for example, they'll underwrite you based off this main operating account, right? They want to see 3 to 6 months of bank statements. I have a lender right now where you can get $100,000 line of credit with 6 months of bank statements, no P&L, no taxes, right? So let's say you're getting some of these like cash flow based products, alternative fintech, or even MCA. Now, the reason why you want two different accounts is because they're going to underwrite you on this account. But when you get, let's say you go and you get, God forbid, MCA, right? Or actually, let's not use the MCA. Let's say you get working capital. They're going to underwrite you on this account. So you're going to provide the bank statements on the main operating account. When you get the disbursement, you want it to go into this account, right? Because let's say a couple months down the road, you want to apply for another product, right? And I've seen this with clients where they're getting their disbursements into the main operating account. Now, when they apply somewhere else, the lender looks at their bank statements like, oh, you just got a loan from OnDeck, or you just got a loan from Bluevine or Fundbox, one of these other things. So when you're making your disbursements into your main operating account, other lenders will have visibility into that if you should apply for additional funding down the road, right? Especially if they're asking for 3 to 6 months, right? So that's why you get underwritten on this account, but when you get a disbursement, you get it into this because whatever loan that you're taking out, you're going to be paying something off. So when you get the loan, the money's going to be leaving out of your account anyways to either pay off debt, payroll, business expenses, stuff like that. So there's less insight into what loans that you're getting if you have this separated. Now, if everything's just flowing together, underwriter looks at your bank statement, your main operating account, they're saying, oh, you just got money from this bank, that bank, we're going to deny you. And I've literally seen that with clients. So this setup is a little bit better where anything that's getting dispersed as far as a loan, you want that going into this second account, this expense account, because that money is going to be leaving your account eventually. And then your main operating account, I would say just use that for inflows, right? And this is for outflows, all right? And then occasionally you might take a little bit of money, I would say every 3 to 4 months, and move it into your expense account. But remember, you also have credit lines over here where you're actually transacting and you're just paying off that debt, this credit that you got using this expense account. So money is always going to be leaving out of here to pay off other stuff. And this account should just be for your customers, your clients, any money that you have flowing in, whether that's through invoices, POS systems. And this looks nice and pretty for underwriting, and this one for expenses. Now, ultimately, if you do have to provide a P&L or a balance sheet or something like that, lender is going to have visibility into all of these accounts. But from, let's say, a cash flow based underwriting where you just connect an account, and usually sometimes it's only one account you could connect. This is the account you want to use because this is going to look favorable. All right. Now let's get back down here to the CDs. Now, a lot of people criticize, like, why would you put money in a CD and make 4 or 5%, right? Couldn't you just put it into the stock market and real estate? That's not really what this is for, right? And I'll explain.